but that means I need to pause the music because I'm going to be in trouble. Um, so today so what we did for those of you that are going to join us by recording, we're in the in-class notes, which are linked in the side of this week in the lesson plan document. And then if you come down here, you click on the jump and it jumps up you to today's date. You guys are the only ones that have class Tuesday and Thursday. On Monday and Wednesday, I have Algebra 2 and Geometry. And so we're going to start with this simple warm-up right here, and I'm going to check that. And I'm going to take attendance right now. So while I take attendance, I'm going to pause the recording. And looking at the questions, the percent of a medical bill you pay is called co-insurance. Okay, so that comes right off that health insurance 101, where the co-insurance, you multiply the bill times the amount of co-insurance. Some co-insurance is 80-20, so 20%. Some co-insurance is 85-15. Some co-insurance is 90-10. But typically you have a co-insurance and you pay a percentage. There's this word right here, copay. I want to make sure that you guys know copay also, because copay is not a percent. So you might say, well, it's, what you pay. It is what you pay, but copay is not a percent. Copays are set as a set dollar amount. So for example, you might have a copay of $10 per doctor's visit, or you might have a copay of $20 per dental visit, or you might have a copay of $3 on medication. Okay. So copay is what you pay, but it's not as a percentage. All right. Co-insurance is as a percentage. And by the way, just so we're clear, the reason why insurance companies are adding on copays and deductibles also, but in less so in health insurance. But the reason they add on copays is because they're trying to limit your consumption of healthcare. Okay, they want to insure people, but they don't want these people to say like, oh, I got something's wrong with my foot, I'm going to go in and check it out. Or I have an upset stomach, I better go to the doctor to be safe. If you have to pay a copay or co-insurance, then there's more pain because you're not going to want to pay to go to the doctor. So they add these copays and things there in order to make sure you have a real stomach issue before you go to the doctor, or you really need to get your foot checked out, and it's not just where you can just wait a couple days, ice it, take some ibuprofen, and it gets better. Because if when people overconsume, and this word hypochondriac, have you guys heard that word, hypochondriac? Let me know if you know hypochondriac. Some people, like, every little thing to them is like, oh my God, something is terribly wrong. I need to get, like, it could be, at the extreme level, they're like, oh my God, it could be cancer. And yeah, I'm not saying like you shouldn't be wary of a disease. Like, I mean, if you're feeling sick, you should get it checked out. But there are people who do overconsume, and insurance companies hate those people, obviously, because, well, those people are very expensive to them. And then a deductible is paid to the service provider. So that goes for health insurance and car insurance. Wherever you go, you're going to pay the deductible to them first. Well, when you get billed for health insurance, like for a doctor, you'll actually pay that when the second bill comes, but technically it's still first. Okay. All right, let's see. I learned that your grades affect car insurance and premium level. That is true. And I imagine everybody wants to find ways to encourage kids to do better at school. So the government's probably in on that too. But really, I mean, it's true. Like, a lot of times, like on average, obviously there are exceptions in life, guys. I mean, don't think that everything is hyperbolic, but the students with better grades are typically more responsible. So those kids are probably going to file less claims. How to figure out how much tax is taken out of certain pay. All right, that's tax bracket activity. Having a higher premium means lower deductible. That's a really good thing to take away. I was thinking about putting that question back on this warm up. If you want a lower premium, get a higher deductible. The different types of health insurance and what they do, HMOs, PPOs, good. How to find how much you pay with insurance, yes, and it's always complicated. So, I'm going to give you some life advice. Okay. You're going to have these complicated hospital bills, medical bills, and you know like how it's done, not that you can see all the parts. Sometimes you have to ask for an itemized bill. Sometimes you should ask for an itemized bill. If you go to the hospital after a car accident and they treat your arm, your leg, and your shoulder where the seatbelt hit you, they're going to send you this giant bill, and you should ask for an itemized account, like how much did that Band-Aid cost? How much did that medicine cost? How much did it cost for your stay? How much did it cost for the nurse? Because the people doing these bills are human beings and they make mistakes. I'm not saying that there's, sometimes people get malicious with the billings, but a lot of times there are problems, and that costs you money. It also costs insurance money. But ask for an itemized bill and go through it and make sure that nobody made a mistake. That will save you money. Okay. I learned what a copay is. Awesome. And then let's just check. No questions, no questions, no questions, no questions. Boy, you guys are super curious. That was sarcasm. I'm sorry. All right. So here's what we're doing today. It's a whole bunch of stuff. Let's go over health insurance 101. Yeah, and then copay co-insurance. Okay, health insurance 101. I realized that I put this without the category, so I put it back in the category. The number one reason, oh, you know what? That was right there. That's health insurance 101 with the things. Sorry. Here's the summary right here. So 19 to 28, somebody got 19. The number one thing people messed up on was there was a cap, like for example, the first president had a cap at 8,000. If you have a maximum, you're not going to pay over the cap. Okay. Most insurances have a maximum that the insuree will pay. So in other words, if my cap is $8,000, that means I know I won't have to pay $8,000, more than $8,000 in a year. So between deductibles and copays, and I believe it includes copays, deductibles and co-insurance and all that, I will not pay more than $8,000. After that, they will cover everything, which is really nice. Now, some insurance companies I'm not sure if they still do, but some companies had a maximum that they will pay. In other words, they might say like, we're going to cover you, but after we pay the medical providers $150,000 for the year, we're done and you're going to pay everything else. Okay. I know that was common in the past, and I think that the Affordable Care Act might have fixed it, but I'm not sure. There might still be. So you want to also ask if you have a maximum, now that you're probably never going to hit the maximum unless you're super unhealthy, or unless you get like in the worst disease known to man. I mean, if you're healthy, you're not going to hit it. But it's worth noting that they have done that. Okay. But typically there's a maximum that the insured is going to pay. And so on this assignment, there were one or two people who calculated the amount they were going to pay correctly, but they forgot the max. So it can't be more than the max. Does that make sense, everybody? The other thing that people forgot to do is they forgot to add the deductible back in, or they forgot to take the deductible out. But there is a help video. Watch the help video, go back. If you still can't get it, send me an email. We'll Zoom one-on-one. Okay. This tells me that, we're doing really good. Most people got 26, 27, 28. That's 5 out of 10. And there's 2 students who are not turning in anything, and their grade is not very good. So that's that. Okay. All right. So that's health insurance 101. Any questions, or does anybody want to ask about a question on health insurance 101 right now? You guys good? Can you guys tell me you're good? I do like hearing from you guys. Okay. All right. Last chance, or forever hold your peace. We talked about copay versus co-insurance, and today we're going to talk about tax brackets, risk pools, tax bracket activities, and we need to go over the student conferences. So yes, I've been busy. Shoot, I hate this mouse. I realized that I did not post the assignment this morning, so what I did was I moved this up. So this is your assignment today, is no financial math, but you're going to do the student self-report found in the BVLA high school Google Classroom. Let's look at it right now. Come here to the BVLA and go to classwork and go to must do student self-report. This is it right here. This is what you do. You guys are going to have to make a copy of this. Okay. So go to file, make a copy, and that way you have your own copy. Entire presentation, obviously. Okay. Now this is a template. So you can use this template to just fill in what you need to fill in. But I also want to invite you to add to it or change it if you want to make it your own. Okay. And we do this because we're offering parents and students opportunities for conferences, but also this is a really good reflection tool to see what you've done. Okay. So this says make a copy and then delete this page. And then again, I hate this mouse. This says my strengths, tell me things that went well this semester, tell me things you've improved since the beginning of the year. Just be honest. And then this would be like financial math. Or do you guys have English? This would be like English. Okay. So just, replace it, highlight it, type it in, replace it. What's your grade in the class? And then put an artifact right here. An artifact is like, so for my class, what is a good one? Well, you guys did your contract PBL. Okay, and you can put a link in there too. You can use a link, but you can screenshot it and then add the link to the screenshot. To add the link, like right here, you just go to this button right here, insert link. Okay, you have to make sure it's shareable. You guys have your contract PBL. You guys have your the other PBL we did was the human capital one where you guys picked a job. That would be a good one. You can put in any like the budget. If you did the budget, you're really happy with the budget, put that in there. Okay, pick something that we did in class and put it right here, and then tell me why you chose the article. And then this is your Edgenuity classes. So put in your Edgenuity classes. If you don't have 3 Edgenuity classes, then go and delete the slide. Delete the slide. Okay. And then it says, write thank you and delete this. Just clean it up, make sure it's nice, and then insert it into that Google Classroom. And you'll see people have already done it. Okay. Any questions on that? If you have no questions, type in I'm good. All right. Well, you guys have listened well all year, so I believe you. All right, I'm gonna go to insurance to build wealth. So these notes right here. And I'll share it with you if you want. All right. Tax brackets. This is a very commonly misunderstood thing that a lot of people are confused about. And a lot of people are also screaming and crying over how unfair it is when they have no idea how the hell it works, or they are trying to purposefully gaslight someone and, you know, purposefully trying to use the confusion to their advantage. Okay. Tax brackets are marginal, which means it only changes on the margins. All right. And the other thing is there's another complicated thing because there's what's called a standard deduction. So let me tell you about this. All right. If your taxable income is between $0 and $9,700, you're going to pay 10% of the taxable income. Okay, so 10%. So if you make $2,000, then your taxable income, oh, I'm sorry, your taxes would be 10%. So if you made $10,000, you'd pay $1,000 in taxes. Okay. But there's a standard deduction, which means the standard deduction is like a subtraction off of the amount you pay. And the standard deduction for this year, I believe, is like $6,000 for an individual. It's something like that. Okay. And so if you made $10,000, you pay 10%, that's $1,000. Your standard deduction is over the $1,000. You would get a refund back. So you would get money from the government. All right, so all these low income workers that complain about taxes, they aren't paying income taxes. All right, this system is what's called regressive. Okay. No, I'm sorry, I misspoke. This system is what's called progressive. Okay, progressive. So there's two types of tax bracket, two types of tax systems. It can be regressive, which punishes the lower income people or is unfairly burdening the lower income people. And there's progressive, unfairly, not unfairly, but it raises taxes as people earn more money. And so it follows the idea that the people with the ability to pay should pay. You guys like the story of Robin Hood? What's the story of Robin Hood about? It's this sheriff that goes around and he collects taxes on the poor people of Nottingham, and they can't afford to pay the taxes. But the sheriff says, well, you got to pay the taxes. You live here. And if they don't pay the taxes, then they punish, either the sheriff beats them or they throw them in jail. That would be a regressive tax system. The most people in government have pushed for the idea that if people cannot pay taxes, then they should not have to pay taxes. Because in America, we do not throw people in prison if they cannot pay their debts. Now, that's not saying tax fraud. If you commit tax fraud, they will throw you in jail. Okay. So you have the standard deduction, and then let's say you move up. Let's say you earn a little bit more. So you make $24,000, okay? If you make $24,000, you're going to pay 10% of your taxable income on the first $9,700. You pay $970. And then you pay 12%. So it's a higher percentage on the next however much money. Okay. And so it's not that, oh, I'm in a higher tax bracket, I'm paying 12% of all my money. You're only paying the extra 2% income tax on the higher income. And same thing when you get up to the upper level. The people down here at 35%, you can be in the 35% tax bracket, but you're not paying 35% of your total income. You're only paying 35% on everything over $204,000. So the first $10,000 is taxed very little. The next $30,000 is taxed very little. Okay, so when people say, well, you shouldn't raise taxes on the wealthy because they they're making that money, think about how much different, paying 35%, 35%, that's 1/3 of my money. You're not paying 1/3 of your money. 35% is only affecting the last certain amount of income. All right, does this make sense? You guys understand this marginal tax bracket? Did that clear up any misconceptions you had? I'm wondering what you guys heard about that. Or I'm wondering if you guys heard people complain about like, oh, you can't raise taxes on this people, I'm sorry, I misspoke about progressive and regressive. Here's a question. Let's see. I have a question, but it's not about insurance. Is it true that if someone dies with leftover debt, does it go to the rest of the family members, or does it go away with the deceased person? If you have debt and you die, then the people you owe money to can get in line for your assets. So let's say you have $30,000. By the way, I'm going to say this is what I believe, and I'm not 1,000% sure, but I'm pretty sure I'm right on this. So let's say that you owe $20,000 in credit card debt, and you have $100,000 house, but and then you die. Okay. So when you die, all your money goes into this kind of box that is looked after by the state first. Okay. And the people you owe money to can come and they can make a claim against that asset. So that $100,000 house that you own would be an asset, and people can go and say like, well, okay, so this person owes me this money for that. And then they can take the money out of that asset. Okay. So in other words, after the $100,000 house, after you deduct the 20,000 that's going to be paid to the credit card for the debt, then the kids could inherit the $80,000. Okay. But if the person has no money, then there's nothing there. And the person, the people that loan the money would be out of luck. They wouldn't get anything. You can't go after the kids. Can't go after the kids, but but they get first crack at the money. That includes student loans. So if if your mom has student loans and your mom dies, you're not liable. So what people try to do is they try to, handle all their affairs and push the money off onto their kids first, so that the credit card companies or the student loan companies can't get the money first. Now, when you do that, I think you have to pay taxes, and I'm not sure about all the law about that. And they might decide if it's a large amount that that's fraud. But that would be a great question for a lawyer. We need to have an insurance lawyer come on our class. I think I'll try to get a guest speaker. Great question. All right. So we have the standard deduction, and the standard deduction is going to really reduce your tax liability, and it's going to reduce how much you pay. So you're paying, maybe 35% marginally on that excessive income over $200,000, which if you're making $200,000 a year, I think you should pay your fair share for schools and roads and police and libraries and Social Security and, stuff like that. That's my opinion. But let's say that you're looking for ways to reduce your tax liability, and good financial advisors will tell you need to reduce your tax liability. That's one way you play the system. Okay. Not that you should cheat on your taxes, but that you want to preserve as much wealth as possible. You don't want to spend your wealth so you don't have it, and you don't want the government to take the wealth so they don't have it. All right. I'm not telling you to cheat on your taxes. So they have this thing called pre-tax contributions. I think I mentioned this in retirement accounts where you give money to retirements and retirement accounts, and it reduces your taxable income. Okay, so for example, right here in this chart, if your monthly gross pay is $2,600 and you contribute $200 to a retirement account, and then you contribute $100 to health insurance that's pre-tax, then it shows up as $2,300 on your W-2, which we talked about in Unit 1. Was it Unit 1 or Unit 2? Maybe it was Unit 2. And so they only take that percentage, the tax rate is a percentage off the $2,300. Now, that $200 that you put away, it means you can't spend it now. You can't spend it till you turn 59 and a half. But you have that $200. That's yours, and it's not taxed. And that's the power of pre-tax programs. Okay. And you can see pre and post-tax items there on the right. The other thing to know is that aside from you falling into tax brackets, which are set by your income, which is reported to the IRS by your companies, is that you get to choose how you file. So if you're single, you file single, and married, file jointly, you'll notice is pretty much double single filing. There is the concept of a marriage penalty for tax-wise, but I've from all the reading I can do, I can barely understand it. It's set up essentially where if you married, filed jointly, it's like filing singly, and that's just doubled. It's like two people instead of one. Our neighbors are married and they file separately, and they said our taxes, we get a tax advantage by filing separate. Yeah, that means you're filling out two 1040s instead of one. 1040 is the form, name of the form that you fill out when you file your individual federal income taxes. Me being a tax expert, I'm not quite sure what's going on. I know that his income is significantly higher than hers. I don't know if one of them has something going on where they have a lot of tax deductions or tax credits where they will end up paying very little. Okay. And then there's heads of household, and I have very little to say about that because I have not read about it. All right, questions about tax brackets? Okay, so your next assignment, well, let's look at tax bracket 1 and then we'll look at tax bracket 3. Okay, this is a really good video. I hope you guys watch this video. This video can explain the concept of tax brackets way better than I can. Okay, these are professionals. All right, tax brackets from 2020. The tax brackets change constantly, and they're you know, like for example, Donald Trump was elected, and he, you know, when he can sign off on the bills passed out of Congress, and so the Republicans had all three chambers, so they passed this tax bracket, this tax law in 2017, I think it was. And the big thing was they said like, oh, we're going to jumpstart the economy by lowering tax brackets, and we're going to lower corporate income taxes. And their idea was that they would, you know, if you don't tax people, then people have more money, so therefore they spend more money. And that is kind of true. It's this principle called elasticity, but it's also not kind of true. So basically they lowered, they either got rid of or they lowered this top bracket right here. Maybe it was like 39%, or maybe they lowered it or whatever, but so a lot of upper class people paid less in taxes. That did not affect down here. Like, they didn't change these tax brackets down here. They affected the people, making over $500,000. Now what they did do is they increased the standard deduction. So these people got a slight lowering of taxes because their standard deduction went up, and also their child tax credit. If you have children, you get a tax credit and it changes. But so essentially the government says, well, you have children, you have expenses to pay, so we're going to give you a credit on your taxes, which is like a reduction in taxes also. But then, if the government doesn't collect money, then it can't pay its bills because the bills don't change, right? And so our, deficits went up, which, is that their decision? Like, they get to decide how much deficits to run. But, my argument is you've got to pay for services. You've got to pay for, the healthcare of people that need it. You've got to pay for, fire and police, and education is important, and you've got to pay for roads, and you've got to pay for, the national defense, the army, and you've got to pay for environmental protections and the bureaucracies that help make our democracy run. And, they support voting, voting agencies are run out of the state level, but they get some money from the federal government. So you're going to pay for all those services. So you've got to find the money from somewhere, All right. So what you do is you read, and by the way, these people, if you ever read names, I'm supposed to change the names to your names for every year, but I didn't get around to it. So these are names of former students of mine. So we're going to go to this link right here. Let's see, here's the calculator. Marginal tax rate calculator is what it looks like. And you read this and it says, Brian makes 42,000 per year. How much money will he pay? And it says all problems assume no kids, single, and salaries are assumed to be taxable income. So 42,000. So single, no dependents, and you put in 42,000 and you get this. The average tax rate is 8%. Now remember, according to our tax bracket, 42,000 would fall right here under 12%, right? And so you would say like, oh, he makes 42,000, he's going to pay 12%. No, we know that that's not true. His average tax rate is 8%. His tax bracket's 12%. But because he gets the standard deduction, here's the standard deduction right here, $12,550. So what I say, 6,000, I was off. So on average, he paid 8% of his taxes. And then that's the number you say right there. It's 7.95% of your total income of 42,000 would be 7.95%. And the taxes paid, it tells you the taxes paid. Where does it say taxes paid? $1,000, $91,000. Whoa, guys, help me out. What am I missing? Did they change the calculator? I thought it said it right away. I'm having a brain fart. Average tax estimate $2,278. Oh, there it is, $3,338. I'm sorry. So the average, the taxes you would pay is $3,338. So that's the money to put in there. All right. And then I didn't know that was the calculator. Yeah. Yep. I didn't make you do it by hand. I said, there's a calculator, use the calculator. Why do it by hand? Okay, so down here, you just have to read, like right here, it gets married. So you calculate the married, change it to married filed jointly, I think it was. All right. And then this is new, or I didn't see this before, but you can see like, here's the standard deductions right here. You can deduct off medical and dental expenses. So if you have a terrible year and you have to pay a whole bunch of money out, then you can deduct medical expenses, interest paid, taxes to state and local, and gifts to charity. We talked about charitable giving and budgeting, and there's your tax implications. Now, I kind of spoke a little fast. These things right here would go under itemized deductions. So when you file the taxes, you get to choose. Do you use itemized deductions, which is all those, or do you take the standard deduction? The standard deduction for most people is higher than the itemized deduction. And the standard deduction is automatic and simple. And the itemized deduction, you have to do the math and add them up. So you have to save your receipts through the year. Okay, if you give a lot of money to charity, if you pay a lot of interest on loans, if you pay a lot of state and local taxes, like New York would be a high state and local tax district, Kentucky is not. Or if you have a whole bunch of medical expenses, then you get to itemize that and pay less, okay? All right, so I'm sorry, I can't even read my own calculator assigned. Okay, so that's that assignment. Any questions on the tax bracket assignment? Okay. So let's talk about HSAs, okay? Health savings accounts are just like those retirement accounts that were on that previous slide. They're pre-tax. So if you put your money in a 401k, you reduce your taxable income, you can lower your tax bracket. But when you go into the retirement account, when you put money into the retirement account, you can't touch the money till you are 59 and a half. And HSA is very similar. You put the money aside into a account, but you can take the money out of the account right away for medical spending, doctor's offices, medical bills, prescriptions, things like that. And so it's a way to reduce your taxable income. If you know you're going to spend $3,000 on medical expenses because you count up the average you've spent in the last 5 years, kind of what goes wrong. If it's like every year I break my leg, I can't avoid it. So every year I have to go to the doctor and this is my deductible. Then you can have a HSA and that $3,000 is spent tax-free. Whereas if you got the $3,000 in your regular paycheck and you pay the doctor, you pay taxes on it when you get your paycheck. So HSAs are really powerful. They also allow you to roll the money over. So let's say you put $2,000 into an HSA in 2020 and you don't spend $2,000. Whatever money's there gets rolled over into 2021. And while it does, a lot of these accounts will pay you interest. So that means that you're not losing out to inflation the way you would on a basic savings account, like we talked about in chapter 2. Okay, so HSAs have a lot of benefits and it's something that you can use right away. Now, that when you guys apply for full-time jobs, okay, this is run out of the insurance companies that are put out by full-time jobs, by jobs. So let's say you work for G, you have an interview for G. Let's say you have an interview for G and you go to G and they're like, we think you're a good candidate. We can see you're smart. We think you have a good personality. We want to offer you this job. We're going to offer you this salary. You might ask them, hey, what are some of the other benefits of working here? And by that, I mean like retirement accounts and health insurance with HSAs. Because at GE, you might get an HSA opportunity that you don't get at, for example, UPS. Now, both these are big employers. They probably both offer HSAs, but well, let's say you get a job offer at a small, mom and pop company and they don't have it. It just goes by employer. Some big employers don't have it. Some small employers do have it. But when companies can offer you HSAs and retirement accounts, they're essentially offering you a higher wage because they're lowering your tax rate. And that's an important consideration when you have to choose between, do I work here, do I work there? Okay. Any questions on HSAs? By the way, the way I do it is I pay for all my medical insurance with my credit card. So I get a bill from the doctor, pay it off with my regular credit card because I get a reward for the credit card, like, 2% cash back or some whatever. And then I go to my HSA and I ask for a reimbursement. So I keep my receipt, I send my receipt to my HSA and I get a reimbursement from it. And they direct deposit the money into my account. And so I'm trying to double dip. I'm trying to get the perks for the credit card and I'm trying to get the tax-free benefits for the HSA. You also get a little debit card for your HSA so you can pay right at the spot with your debit card. And so you could make it that way and make it really easy, okay? Okay, I'm not gonna have time to get into risk pools because we've already covered an hour. Somebody asked a really good question, why insurance is so expensive. And I want to have this conversation sometime, but I've talked for an hour already, and I'm sure you guys are done with hearing me talk. Okay, make sure to watch the video. All right, so let's say Brian has $42,000 a year and he's going to contribute $3,600 to his HSA pre-tax. How much money will he pay in taxes? Okay, so you're going to go back to the calculator. Here's the calculator again. It's the same link. He's single again. He makes $42,000, but now he's contributing $3,600 to his HSA. So what did we say HSA contributions or savings due to your taxable income? Do they lower it? Do they make it stay the same, or do they make it go up? What do they do to it? Everybody should be putting something in the comment right now. They lower your taxable income. So you're going to take $42,000 and you're going to subtract the HSA contribution. In this case, it's $3,600. So now his taxable income goes to $38,400. Okay, so what happens to his taxes? His taxes went from $3,300 to $2,900. His tax rate went from 8% to 7.57%. Well, I think it was 7.95%. Technically, it was 7.95%. So HSA lowers your taxable income, and so it lowers your tax rate. Okay, and you still get to spend the money right away on qualifying medical expenses. That's right. You're going to get the answer right here. The math is going to be changing this. So remember, in the question, he makes $42,000 a year, but his contribution to his HSA was this. So in this form, I'm not putting in 42,000 anymore, okay? Make sure you guys hear me well when I say that, because I'm trying to help you guys out. Yeah, do you guys have any questions about how to do this assignment now? Okay. All right, good. All right. Did you guys learn something new today? Good. I hope that this is valuable to you. You take what I'm hearing and you can apply it to your life in order to have an easier, happier, healthier life. Okay, and to help you on my assignments because I'm giving you homework. But don't ever stop learning, guys. Hopefully you will be lifelong learners where something will pique your interest year after year after year. And I can't tell you exactly specifically what to do because the tax law changes. HSAs have not always been around. The standard deduction changes, tax rates change. And so you have to know the system and how it works, and then you have to apply that to you. So you might have a very different situation than me, okay, and everybody else. So you can't just say, just tell me what to do. You have to figure out what's best, okay? And don't ever take the lazy way out and just say, well, I don't want to learn this, okay? Because you're gonna, I mean, we're talking about, in this case, we're talking about money, but in life, you're gonna make your life way easier and happier and healthier when you guys commit to, learning, commit yourself. So thank you for coming to class. I appreciate you guys giving me your time. Do we have to do something specific? And the answer is like avoid decimals, dollar signs. You need to round to the 10th. I had to go back and change some of your tax rates because you didn't round, you rounded too big. Round to the 10th. If it's a dollar amount, put a dollar sign. If it's a percent, put a percent sign. You guys can't see the direct message. The question was, do we have to do something specific for answers like avoid decimals, dollar signs? Okay, all right. You guys have a great day. Do something nice for yourself and for everybody else, and help each other out there, okay?